When you look at the Fed, the fact that actually they could move down or up in terms of interest rates, what makes you nervous about the markets? Is it mispricing? I also have a great chart, which I'll show in a second, looking at the flattening yield curve that could be back to inversion.
Right. So I think the market is pricing in too much of this this risk of essentially near-term rate cuts. I think what we heard from the Fed, and we've sort of continued to hear that same message from the Fed, is that the economy is actually okay. So growth is certainly slowing, right? We were growing around 3% last year. Now if we're growing around 2%, that's still trend growth. Inflation has disappointed, but if it's transitory, if inflation does get closer to that 2%, the Fed can actually stay pat here. So, you know, we're close to neutral. The Fed really doesn't need to do a whole lot. I think what's significant is that they've actually told us that they're ending balance sheet runoff. I was extremely nervous that the equilibrium level of reserves is much higher. I think the Fed's seen that writing on the wall. They're ending. At some point, the Fed is going to start buying treasuries in the open market. You know, based on our analysis, there could be as much as 300 billion of treasuries per year. So you have net issuance of $1 trillion, and 30% of that will be taken by the Fed. So I think what they're trying to really do here is to keep, you know, policy essentially neutral, both on the balance sheet as well as on the rates front. So I think the market's a little bit worried. Now, clearly, there's lots of reasons why the market's worried on the trade front, on global growth, on why is Europe not really picking up growth here. So I think that's why the market's pricing in these near-term rate cuts.
Okay, a key part of the U.S. yield curve, and I want to bring in my terminal, is edging back towards inversion. How do you look at that?
I think that's a function really of the global rate environment. You know, when 10-year Germany is close to zero, it's very hard for that US 10-year to essentially sell off. So I think the flight to quality has sort of brought, you know, US 10-year rates lower. But I think if we look at any historical episode, term premium or essentially the amount of compensation you get for extending out the curve, it's going to be much lower because global rates are much lower. So I think the yield curve as a signal, it's not that strong now, given the global rate environment.
The global rates, that's right where I wanted to go. Do we care about low German rates? Do we care about new, ever more negative German rates in America? Do I care about that?
You should care about it because essentially it's going to keep U.S. interest rates lower as well. You know, there's a lot of money on the sidelines, and there's
price up, yield down.
Yes. So
really,
essentially,
I got that right?
You did. So essentially what this money is all chasing returns. And if I have JGB yields at zero, German yields at zero, well, then U.S. Treasuries at 250 look pretty good.